Welcome. My name is Len Lane, and I am the founder and president of Brokers for Life, Inc., and we are Dominion Lending Centers in Western Canada. The topic of our podcast will be about what we consider to be real-life mortgage solutions. Welcome back. We are back again talking about credit. Ongoing subject that never seems to end. My guest again today is Sandra Landry, Senior Vice President for MNP, who are members of Praxity. I had to look that up, actually. I didn't know what Praxity was. That's a huge organization out there of independent firms. So welcome back.
Thank you so much for having me, Len. It's great being back.
Yeah, it's always good to talk with people that are as as I hate to say the word nerdy, but yes, nerdy about the stats, right? It's I'm on the Equifax call every 2 weeks. Lately, they have something else coming out, but so tell us what MNP is seeing in the markets.
Oh, we're seeing a real shift here in the markets lately. Bigger files, more files for us, a lot more complicated. Businesses have been involved there for a couple of years. There was a bit of a slowdown after the pandemic. Things had gotten slow, and it slowly ramped up for a number of years. And what we saw is that the files were smaller for quite a long period of time. The debt didn't seem as high. The payments that they had to make, they didn't seem as high. But I've definitely seen that shift over the last, I would say, 6 to 8 months. There's, at least as far as what we're saying here, is bigger proposals, bigger debt, some business involvement that isn't just self-employed or holding companies, those sorts of things. But we're seeing where there's real assets and real debt that are shifting from those businesses.
Yeah, and that's a number that we're seeing a lot more consumer proposals, people coming out of them, some of them doing the right things to become mortgage holders again in the future, some of them not. Some of them, it's like I've said in the past, it's people get scared of what is actually, they don't want credit anymore, but that's not how this world works, right? As we know, it's an ever revolving thing that you need to, if you had a problem, well, there are ways to fix it up. So when you say bigger files, what is it? Just dollar wise, or is that the amount of debt that's in it?
A little bit of both, actually. So I'm seeing bigger debt levels, but I'm also seeing higher income levels. And so when we're talking proposals specifically, we're always going back to compare what would happen in a bankruptcy. And essentially the way that bankruptcy works is the more you make, the more you pay, the longer you stay in. So when we do that calculation, we say, somebody under a bankruptcy might pay, let's say, 30 cents on the dollar. Well, in the proposal, that means they're going to have to offer something bigger. There has to be a benefit to the creditors to accept a proposal. So they might be looking at 50 cents on the dollar or whatever that number works out to. So those numbers is where we're getting bigger. And percentages are relative, but 70 cents on the dollar might mean they're making $1,000 payments versus $200 payments a few years ago. So that is the bigger shift, is their income levels appear to be higher and or they've got some assets that are part of that unprotected group, the non-exempt assets. And that could be like a TFSA, or they've got properties with equity in it. And you might be a lot more familiar with that, but we're certainly seeing a lot more properties that are showing significant equity here up in Edmonton, down in Calgary, more so across the country. There's more of that.
Yeah, and that's something we're seeing here. Of course, the Edmonton market has been fairly strong. It really, in some cases, when you look at townhouses, half duplexes, things like that, there's nothing under 400,000 anymore, where 3 years ago or 4 years ago, even, you would have bought that for low threes, right? So equity is definitely building in the real estate side. There's no question about that. But again, like you say, the more money you make, the more you may have to pay, right, to go into consumer proposal. So at what point does it just make sense to go into just full bankruptcy, or does it, I guess, at any point?
I guess that kind of depends. Bankruptcy comes with a lot of risks. And so we always say that's not a decision people should make lightly, because when you're deciding what's best for you, you're trying to predict your own future, essentially, which is not an easy task to do. And so if you are, say, unemployed when you file a bankruptcy, maybe you're just making minimum payments in. If you're a first-time bankrupt, maybe 3 months in, you find employment and now you're making really good money. You could now be a 21-month bankruptcy and you're paying significantly more. There can be a real shift. And so I don't think there's an easy answer for when it's just easiest to file a bankruptcy. It kind of depends.
Yeah, and we talked about this before, where the bankruptcy doesn't really, the consumer proposal, it's you lay it out and what the payment's going to be, that's what they're going to be. But the bankruptcy continues to fluctuate and change as your lifestyle, I guess, or income changes for sure, right?
Yeah.
And that's one part I think that people, I was shocked when I heard that the first time. I'm going like, well, doesn't bankruptcy just mean that's it, we're done, here's the keys back, right? Sort of thing. Have the Bronco back and let's move on. But it's not, right? So I think that's a part that would surprise a lot of people if they're looking at both. And it's probably the reason we see a lot more consumer proposals than we do bankruptcies these days. It's been a long time. I've seen them over the years with, they're in their third bankruptcy, and because there was an easy mode to do, I guess, maybe at one time, but not so much anymore, right? So
it was. There's been so many changes in the legislation over the years. At one time, proposal was kind of unheard of, and a lot of trustees weren't doing a whole lot of proposals until, into the 2000s, right? And even when I started working in the insolvency field, I think in 2010, there was still a lot of trustees that were mostly filing bankruptcies even yet then. It doesn't mean that the legislation didn't exist for it, but it wasn't as common. And so lots of trustees weren't even that comfortable with it back then. But as it grew and as the legislation changed, it became a little bit more accessible, I guess, for people. So a lot of those folks who have filed 1 or 2 bankruptcies in the past, they were a long time ago, and it was very simple. It was probably 9 months or 12 months, and I don't remember the timelines that far back, but the legislation does penalize now. The more times you're bankrupt, the longer you're going to stay in, and at some point, on a third-time bankrupt, there's no end date. And so that is a little scary for somebody that needs financial help. So proposal is probably a more secure way to deal with their debt.
Right. So 3 strikes, you're never going to have that come off your credit bureau? Is that basically?
Well, you'll have it come off, but there's no legislated timeline of when you are done. So on a third time plus, it means you have to go back to court and tell the court why you think you should get out of a bankruptcy, and they'll decide how long you stay bankrupt. Yeah.
That's interesting too, because that's that could be a really long process. Of course, if you're at your third bankruptcy, probably probably should just give up on credit. Personally, I think, but
right, and those ones they're gonna look really hard on why you were bankrupt in the first place, the second place, and why are you here today? Yeah. And sometimes it makes sense, and you say, I can see where this would have happened, but if you're, a high tax debtor the first 2 times and you're bankrupt again, you can't expect that you're going to get a whole lot of leniency from the court or from CRA, I guess.
Yeah, or from CRA. They're not lenient at the best of times. So in all of those proposals, like say the numbers are getting bigger, do you see much mortgage debt in being included in that, or is that kind of set aside and people are keeping their mortgage going?
A little bit of both, I think. The tricky part with the mortgages, as you know, is a lot of times if people let their homes go, what they end up having to pay in rent can be significantly higher than what they would have paid on their mortgage. So it makes those decisions really difficult as far as whether or not they should even keep their property. Of course, once they've already stopped being able to make payments on a mortgage, if the ball is already rolling, it's pretty hard to stop that ball from rolling. It's probably going to end up foreclosing. But
right.
Folks who are kind of on the edge, that's a big consideration for them. And it's, so we have the conversation. Well, if we get rid of all of this unsecured debt, do you now have income sufficient to pay that mortgage where you can keep going and you can rebuild? But if you're still not going to have income sufficient to pay that mortgage, you've got to do something different.
Right. Yeah, I can see that. It's the insured default number is ridiculously low. Always has been. It's sitting at 0.21% today. I'm going like, okay, any business in the world would love to have a 0.2%, number of people who haven't paid you. So it's quite low. That consideration, we see that every now and then. Again, something depending on where you are in the country. If you have what they call a dog crate apartment in Toronto, there's zero equity. You're probably upside down in it, right? 500 square footer. And I think that's starting to show up in Vancouver as well, right? Where we're seeing the values are sliding slowly, not overly as quick as people would think. But I think over time that an adjustment is coming.
I think so too. And I know you and I kind of chatted about that in our last call. There has to be an adjustment. I have seen some stats come out that suggest there are quite a number of individuals that previously lived in those bigger centers, the Vancouver, the Toronto, that are now moving away from those centers and into different parts of the country. So it's definitely going to impact both of those areas. And I think Alberta is one of the largest places or one of the places where the largest shift is coming, and lots of folks are moving into Alberta.
Yeah, the in-migration numbers are, I don't know if that is for quarter. I can have it up on my screen. We're looking at probably close to 15,000 people per month.
That's a tremendous amount.
It is. And of course, coming from Ontario, and you see the license plates. I've lived here through several booms and busts. A lot more Ontario plates, a lot more BC plates. The odd green one from Saskatchewan, but he's probably just visiting. So it's interesting to watch. And I caution my agents or associates rather that it's they may not stay. And I've seen that in the 80s, and we've seen that in the 90s. People come, but and when I first moved to Alberta, there was probably 20 of us from the hometown that I grew up in. And I doubt that there's 5 of us still here this many years later. And they just, work their way back to where they came from or somewhere closer to home. And, it's just reality. So be careful of what type of mortgage. Of course, the local credit unions sometimes have great numbers, but it's not portable outside of Alberta, things like that, right? So it's a caution to watch. If they have to break a mortgage, you want something they can port, I guess is my point, right? So
yeah. And a lot of the folks that we talk to, they don't necessarily understand those pieces. And we send a lot of folks to mortgage brokers because it's really important for them to understand the variances in those mortgage. Just because a lender has given you a good rate, it doesn't mean it's necessarily a good mortgage for you. So you really need somebody to talk through what your plans are, right? And to have that conversation, how long do you plan on staying? Like if you're planning on staying 2 years and you get into a 5-year fixed mortgage that's not portable because you had a good rate, what's your math going to turn out to be when you try and break it?
Yeah, and it's surprising. You'll find even the short-term mortgages right now, people, of course, not that long ago, 5.35 for a 3-year term was pretty common. It's like 4.39 this morning. So people are trying to break those mortgages, but the banks have they all have a different calculator, I guess, if you want to call it, right? They want their discount back as well as the IRD, interest rate differentials and things like that. So, and I'm going to have to think that even in your case, if they're needing to take the equity out of a property that penalties can be considerable just to even refinance, right? Even and stay with the same bank. So I'm sure that's a major factor that shows up on a regular basis for you guys as well. So
yeah, it really does, and that's sometimes part of the reason folks will do a proposal is because under a bankruptcy they're going to have a limited period of time to get that equity out, or alternatively that the property has to be sold, but then you end up in that problem again as finding a new place, trying to find rent for a reasonable amount of money. So proposals tend to be better only because it gives them a longer period of time to get that equity paid back in and still pay their mortgage.
Right. And that's because rents here are still climbing. There's no question. It's if you're going to rent a house in Alberta and Edmonton, at least anyway, you're probably close to $3,000, right?
Yeah.
No, 2-bedroom, $2,200 easily. Not too bad.
That's a lot of money.
It's actually compared to a mortgage, it's considerable amount of money. But again, with all the government programs and everything that are happening, it's still hard for people to get started into a new place, and paying rent it makes it really hard to save a down payment as well, right? So when you're paying out that kind of money,
I had been looking at the Equifax. What did they call it? The market pulse, I think it was. And I did notice on there, it was talking about younger consumers, and they tended to come up in a couple of places, but in that age area, they seem to be struggling the most, right? With getting into the market, being able to borrow for mortgages. Their debt levels seem to be climbing at higher levels than perhaps some of the other folks. So tough group. I think it was 26 and under, or under 26 is I think what they had said. That is not a good place to be when your debt is starting to climb. The impact of bad credit is significant in that time period when people are trying to build wealth.
Yeah, and if you're just starting out and having to pay a couple $1,000s a month for rent and right, and the price of food and everything else, it has not come down at all since the pandemic. I don't feel it, and add some tariffs to the mix, and everything else is going up from the price of tin cans to you name it. There really is nothing that has come down in price. I have friends that own restaurants, and they're like, their margins are getting thinner because you can only charge so much to a point where people just don't come out to eat, right?
That's right.
Not too hard to be at $25 a plate easily. At a bottle of wine, and you're well over $100, right? So
it is, yeah. And I know inflation has dropped, which is wonderful, and I think it was down to 1.7%. But it makes you think that everything is supposed to be easier and more affordable. But specifically, fresh beef is still up just over 16%. Tea and coffee is still up just over 13%. The things that we, as Albertans, are still consuming a fair amount of, inflation didn't bring those back down. So despite inflation coming down, we're still feeling that.
Yeah, and I don't know, like I said, the inflation number came down because, of course, they took some carbon taxes off and stuff like that. I think it was probably the majority of it that, taking tax off of anything, is going to bring inflation down. But, gas at $1.17 this morning or something like that. So it's not too bad. I don't know what they'll do in 2030. We'll have to drive electric cars, but we'll see how that goes. We'll be taking the bus to work.
We'll all be getting scooters.
Yeah, there we go. Oh, they're lying all over the place downtown, so not hard to find one. I'm sure you can trip over one on the way to work. Yeah, so it's kind of interesting. There's always lots of different changes. Bank loans for cars and stuff like that are still expensive as well. I actually, I have a tax write-off that I drive around the city. So I actually went back to leasing because leasing was 3%, 2.99.
You're right. And actually, leasing has become a lot more popular in the last year or so for that very reason.
Yeah.
And there for quite a long time, there was not a lot of leasing that was happening. I think we're going to see a big shift in that market as well. The used car market was a lot more popular for a number of years, but because it was so popular, the values of the vehicles were perhaps inflated to what they would be today, and so the loans on them are quite a bit more significant.
Right.
We see a lot of folks in our office that have very big loans on vehicles that really don't warrant the loan size that we're seeing. And some of those folks, they are adamant they're going to keep those vehicles, and they say, yep, we'll pay them and we'll figure out it's really important to us. And then others that say, it makes no sense for me to drive a $25,000 vehicle and pay a $55,000 loan.
Yeah. Well, and just, 8% for car loans, used vehicles, right? So
Yeah.
that was part of our math. I'm going like, yes, it's newer and so forth, and I can turn it back in 3 years. I'll move to a beater pickup at that point, I think. But it's it's like, if you have an 8% loan on a used vehicle that's depreciating as fast as you can drive it, it's it doesn't make much sense. And yes, I still see huge vehicle payments. Some that are justifiable if they're bought for actual work, right?
Yep.
Welding trucks and stuff like that are $100,000 vehicles these days. And
They are.
but payments at $1,400 a month. So you better be welding a whole lot of stuff to make it worthwhile, because everything you put on the back of it's probably worth another 50 or 60. So it's got to make sense, I guess, to do that. Just to drive around the city, we actually went to one vehicle in our household.
Oh.
Yeah. So.
And how have you found that?
No, Wednesday morning I take an Uber to the office, which is 6 kilometers.
Yeah.
And Margie does all her shopping and all her appointments on Wednesdays. So it's worked out good, because literally we had 2 vehicles sitting, one at the office, one at the house 6 kilometers away. And the other vehicle was driven so little that I could hardly keep batteries in it, because she didn't drive it enough to to keep the battery charged, right? So when you start to look at that, and I know people go, well, I want to take the bus to work. I'm going like, well, but yeah, you park downtown. I'm sure you have a spot of your own, but if anybody has to pay for underground parking in downtown Edmonton, or surface parking for that matter, I'm sure that bill is. I have probably
it is
no
tremendous.
idea. Yeah, I'm sure. It's to go park for the game downtown last Friday. It was like, this is ridiculous, because it.
Most of those, I think you'd be doing all right for $20 to park for the game. Yeah. And a lot of them require a credit card. So again, we're leaning heavily on credit, even just to park. You have a hard time parking anywhere without a credit card anymore.
Yeah, you got to have the app as well on your phone, because nobody has machines anymore, because you can't trust that either, right? So people damage them and stuff like that. But yeah, it's it's a never changing cycle, I guess, or where some people just get to the point where you're stuck in it, and not consumer proposal, of course, is one of the options to get out of it. Bankruptcy, not as easy as it used to be. People have seen a lot of that. And that's funny when you talk about that. Some of the older files that I have, like early 2000s, that's where you would have seen the 2 or 3 bankruptcies, and quite common, right? And that's where I learned that it's on there for 14 years, right? And, so why is this not gone? Oh, right, the second one. But not as common.
I think that surprises a lot of people, is how long it can really sit there. And some of those older ones, I don't know what it is, but it's like they forgot about them. They just, they move on with their life, and they forget that they're bankrupt somehow. But I don't know if it's because there wasn't the reporting requirements at the time. There wasn't as much communication. They just kind of assumed everything was fine and moved on with their life. And then they come back now, and we say, okay, well, you still have a bankruptcy from 1998, and they don't even remember that it exists.
25 years ago, right?
30,
almost 28, right? You would would have to think that that would show up though at some point, because you didn't go 28 years without. Maybe you did. Shouldn't say that. I guess that is a possibility. I know.
It happens.
But lots of people that just live paycheck to paycheck, or just live well enough on what they're doing, not to have credit, I guess. But
yeah,
doesn't happen in Alberta, I don't think. But there are parts of the country where that is a possibility, right? So
it absolutely is.
yeah. So it's always interesting to see how those unfold. But it's like I said, keeps you employed.
It really does.
Keeps me employed with the refinancing and all of that stuff as well. So we see a lot of that in the last year to pay out debt. That was the other thing too. I think a lot of people came out of the pandemic. There was a stretch there for about 6 or 7 months that every second or third file was a refinance to pay out $25,000 or $30,000 worth of credit card debt or lines of credit, right? So people had become reliant on it, and it's something that hopefully is changing. But from what you're telling me, it doesn't sound like it is. So.
It doesn't. It looks like some of the information out there is suggesting that the increases in credit cards as well as the debt itself is more on missed payments and purchases of essentials versus, maybe a few years ago where it was new purchases,
right,
or new cards, which is an interesting shift, right? And I can't say for sure if that isn't just a spending pattern, right? So I think nearly everything goes on a credit card because I get lots of points and I can get the money back, or I can use it for travel or whatever it is, which is fine. So somebody like me, I'll be part of those statistics. But if it's not getting paid off, then we have a bigger concern, right? If you're buying groceries on your credit card and not able to pay it, that's not an ideal indicator.
No, and I think that's part of what Equifax is kind of saying out of some of the reports lately. And on another call with them next week again, and it's like it's that increasing amount of credit card debt that is being used for day-to-day living, right? So that's unfortunately one of the things that are being watched quite closely. So
yes, it will be, and I know insolvencies are up. We've kind of monitored that over the last number of years, but I think 2024 insolvency filings were just over 137,000 for Canada. And I want to say 2019, they were at 140,000. But that dropped significantly at the pandemic, and it is slowly climbing up. And so we're now nearing the pre-pandemic levels of insolvency filings.
Yeah. Interesting. So just on a side note, do you see many business bankruptcies in your office, or is that more just consumer?
I specifically only do the consumer, but we do have a corporate team here.
Right.
That one hasn't ramped up quite as much as perhaps was expected, but they're definitely still there. They're still pretty steady. They're not increasing quite as much as the consumer side. Some of that has to do with what sits in the corporation. And so because corporate bankruptcies operate so differently, really you're looking at why you want to bankrupt a corporation. And generally it's because you want to deal with assets that are sitting in there. But if a company has no assets left and nothing but debt, there really is no sense in doing a bankruptcy. And so those ones, they end up just, not operating anymore, I guess is what you say, and they eventually get struck from the corporate registry versus actually filing an insolvency. You can't dissolve them because you can't dissolve a corporation without dealing with everything that sits in it. So they just die a slow death is kind of the way I see it.
Yeah. And then, so if there's liabilities, then whoever holds that has to go after personally? Right?
Yeah, depending on what kind of debt it is. So things like source deductions, GST, wages, and anything that's personally guaranteed or joint, they'll go after the director or shareholders or whoever it is they can go after. But the rest of the debt, it just sits in there in perpetuity. Yeah, with no ability to collect, essentially.
I think there's a whole nother show just about that, maybe.
Right? Yeah.
Anyways, on that note, Sandra, I'll let you get back to work. I appreciate your time again. There's always an ever-changing market as far as I can tell with consumer debt and all of that happening. And we'll be watching it going forward to see what falls out in the long run, I guess. So.
Exactly. Well, it was a pleasure chatting with you again. Thanks so much for having me.
You bet. Talk to you soon. Thanks for listening today. I hope you found the information that we provided to be useful in your mortgage journey. And remember, you can always find our associates at www.brokersforlife.ca/associates. Have a great day.